Most investors are playing a game they don't understand. They think it's about picking winners, finding the next Apple, timing the market, beating the index. And for a while, when the sun is shining, they think they're geniuses. Then the season changes and they get destroyed. In 1996, I built a portfolio for my family, not for Bridgewater's clients, for the people I love. I told them this will survive anything: depression, inflation, war, boom, bust, anything. They thought I was being paranoid. I wasn't being paranoid. I was being prepared. Then 2008 happened. The S&P 500 collapsed 37%. Portfolios that looked smart in 2007 got cut in half. My family's portfolio down less than 4%. Then 2020 happened. Pandemic, global shutdown. Markets crashed 40% in a month. The portfolio survived again. Then 2022 happened. Inflation shocked the system. Stocks down 18%, bonds down 13%, the worst bond year in a century. The so-called diversified 60 over 40 portfolio got destroyed. My family's portfolio down 7%. The portfolio did exactly what I designed it to do, not because I'm psychic, not because I predicted these crises, but because I understand something most investors don't. The economic machine has seasons. And if you know the seasons, you can build a portfolio that works in all weather. Let me show you how to earn 25 to 30% returns, not by predicting the future, but by preparing for all possible futures. Here's what most investors get wrong from day one. They think diversification means owning a bunch of different stocks: technology, healthcare, finance, energy, maybe some international exposure, add some bonds for safety. Call it diversified. Call it balanced. It's not. It's a bet, a massive, concentrated bet on one specific economic environment. And when that environment changes, which it always does, the portfolio dies. The traditional 60 over 40 portfolio, 60% stocks, 40% bonds, worked beautifully for 40 years. From 1980 to 2020, it was the gold standard. Financial advisors built their careers on it. Retirees funded their lives with it. Everyone thought the problem was solved. Then 2022 happened. Stocks fell 18%. Bonds fell 13%, both at the same time, something that wasn't supposed to happen, except it did happen. Because the 60 over 40 portfolio only works in one type of environment: growth rising, inflation stable. That's the trap. Most portfolios aren't diversified. They're concentrated bets on economic conditions staying the same. When I look at the average investor's allocation, I see 90% of the risk concentrated in stocks. They think they're balanced because they own bonds, but bonds are only 10% of the risk. That's not balance, that's delusion. I learned this the hard way in the 1,970 seconds. Watched inflation destroy portfolios. Then in the 1,980 seconds, watched deflation destroy different portfolios. The 1,990 seconds rewarded growth, the 2000s punished it. The 2010 seconds rewarded it again. Then 2022 reminded everyone that inflation still exists. Every decade, a different season. Every season, a different group of investors gets wiped out. The pattern is obvious once you see it. The economy only does four things: growth rises, growth falls, inflation rises, inflation falls. 4 seasons, that's it. Every asset responds predictably to these seasons. Stocks love growth, bonds love deflation, commodities love inflation. Gold loves chaos. But most portfolios are only prepared for one season. Sunny weather, growth rising, inflation stable. That's what the last 40 years mostly gave us. So everyone built for summer, now winter is coming. And most investors are standing outside in a t-shirt wondering why they're freezing. Here's the principle that changed everything for me. The economy only does four things, and assets respond predictably to each. Let me break down the four economic seasons. Season 1, growth rising. The economy is expanding, GDP growing, earnings increasing, confidence high, businesses investing, people spending. This is what everyone thinks of as normal. In this season, stocks thrive, corporate bonds do well, commodities rise because demand is strong, emerging markets boom. This is the season the traditional portfolio is built for. Season 2, growth falling, recession, earnings declining, fear rising, businesses cutting back, people saving instead of spending. This is what everyone fears. In this season, government bonds surge. Long-term treasuries appreciate as central banks cut rates and investors flee to safety. Gold holds value as a crisis hedge. Stocks and corporate bonds get crushed. Season 3, inflation rising, prices accelerating, purchasing power declining, the cost of everything going up, money losing value. This is what destroyed portfolios in the 1,970 seconds and shocked everyone in 2021 and 2022. In this season, commodities explode, gold surges, inflation-linked bonds protect you, stocks struggle, traditional bonds get destroyed because their fixed payments become worthless as prices rise. Season 4, inflation falling, deflation or disinflation, prices falling or growth slowing, debt burdens rising in real terms, spending frozen because people expect things to be cheaper tomorrow. This is what happened in 2008, the 1,930 seconds. Japan in the 1,990 seconds. In this season, government bonds soar, cash becomes king, high-quality fixed income appreciates. Stocks crash, commodities collapse. 4 seasons. That's all there is. Now, here's the key insight that most investors never grasp. You don't know which season is coming next. Nobody does. Not me, not the Fed, not the smartest economist on earth. The seasons blend. They shift. They surprise. Stagflation gives you rising inflation and falling growth at the same time, 2 seasons simultaneously. The traditional 60/40 portfolio only works in one season. Growth rising, inflation stable. When any other season arrives, and they always do, you're exposed, unprotected, vulnerable. So I asked a simple question. What if instead of betting on one season, I balanced my risk across all 4 seasons equally? That question led to the all-weather portfolio. Not a prediction, a preparation. Not betting on the future, balancing for all possible futures. That's the difference between gambling and investing. Gamblers predict, investors prepare. Let me go deeper into what drives each season and why assets respond the way they do. Season 1, growth rising. This is expansion. The economic machine is running hot, companies are making money, future cash flows look promising. When growth accelerates, stocks rise because earnings rise. It's simple math. A company worth the present value of its future earnings becomes more valuable when those earnings grow. Corporate bonds do well because defaults fall. Companies can service their debt easily when revenue is strong. Commodities rise because demand increases. More cars being built means more steel. More homes being built means more copper. More people traveling means more oil. The 1,990 seconds were almost pure season one. The 2,010 seconds after the financial crisis recovery, same thing. Long economic expansions where growth kept rising and inflation stayed low. If you were 100% stocks during these periods, you crushed it. But that's hindsight. You couldn't know those seasons would last a decade. Season two, growth falling. This is recession, contraction, fear. Companies miss earnings. Layoffs begin. Consumer confidence craters. The future looks dark. When growth falls, stocks fall. Nobody wants to own companies that are losing money. Corporate bonds weaken as default risk rises. But government bonds surge. Why? Because central banks cut interest rates to stimulate the economy. When rates fall, bond prices rise. That's the mathematical relationship. Investors also flee to safety. They sell stocks and buy treasuries. Flight to safety drives bond prices even higher. Gold holds or rises because it's insurance. When the economy is falling apart, people want something that can't go bankrupt. Gold is a 5,000-year-old store of value. It doesn't have earnings. It doesn't pay dividends. But it also doesn't have debt or counterparty risk. 2008 was pure season two. Growth collapsed. Stocks down 37%. Long-term treasuries up 25%. Gold up 5%. If you only own stocks, you got annihilated. If you owned the right bonds, you survived. Season three, inflation rising. This is when the value of currency declines, prices accelerating faster than income. Your dollar buys less today than it did yesterday. This is what destroyed the 1,970 seconds. Inflation hit 15%. Stocks went nowhere for a decade. Bonds got crushed because their fixed interest payments became worthless. What works? Commodities, oil, gold, agricultural products, industrial metals. These are real things. Physical assets. When paper money loses value, real assets hold value. If bread costs twice as much, wheat is worth twice as much. The commodity itself adjusts for inflation automatically. Gold surges in this environment, not because of industrial demand, gold barely has any, but because it's perceived as real money. When fiat currency is being debased through inflation, gold maintains purchasing power. Inflation-linked bonds, TIPS in the US, also protect you. Their principal adjusts with CPI. If inflation is 5%, your bond's value rises 5%. Regular bonds don't do this. Their value gets destroyed. 2021 to 2022 was season three. Inflation hit 9%. Commodities up 25%. Gold up modestly. Stocks struggled. Traditional bonds collapsed. If you were in a standard 60/40 portfolio, both of your asset classes lost money. There was nowhere to hide. Unless you owned commodities. Season four, inflation falling. This is deflation or disinflation. Prices falling or decelerating sharply. Sounds good, right? Cheaper goods. Not really. Deflation is terrifying because debt burdens rise in real terms. If you owe $100,000 and deflation is 3% per year, you effectively owe $3,000 more each year in real terms. Deflation freezes spending. Why buy today when it'll be cheaper tomorrow? That mindset kills economies. Businesses can't sell, they lay off workers. Workers can't spend. A deflationary spiral. What works? Government bonds explode higher. Fixed payments become more valuable when prices are falling. A 5% bond yield in a deflationary environment is incredible. Cash becomes king. Just holding dollars means you're getting richer in real terms as prices fall. Stocks collapse because earnings collapse. Commodities get destroyed because demand evaporates. Corporate bonds struggle because defaults rise. The 1,930 seconds, the 2008 to 2009 crisis period, Japan through the 1,990 seconds and 2000s. These were deflationary or disinflationary periods. If you owned long-term government bonds, you made a fortune. If you owned stocks or commodities, you suffered. 4 seasons. Each one benefits different assets, and you can't predict which season comes next. So the answer isn't prediction, it's balance. Let me show you how to construct the all-weather portfolio. This isn't based on my opinion. It's based on mathematics. The goal is to balance risk across all 4 economic seasons so that no matter what happens, part of your portfolio is working. Here's the original allocation I designed. 30% stocks. Why 30 and not 60? Because stocks carry about 3 times the volatility of bonds. So 30% of stocks creates roughly the same risk as 90% of bonds. This is about risk balance, not dollar balance. Stocks handle season 1 growth rising. They give you exposure to economic expansion, but they're not dominant. They won't kill you when they fall. 40% long-term bonds. This is critical. Not intermediate, not short, long-term government bonds. 15 to 30-year maturities. Why? Because these bonds have duration. They're sensitive to interest rate changes. When growth falls or deflation hits, season 2 or season 4, central banks cut rates and these bonds surge 20, 30, even 40%. They're your crisis insurance. They're what saves you when stocks collapse. 15% intermediate term bonds, 7 to 10-year government bonds. These are your stability layer. Less volatile than long bonds. Still benefit from rate cuts, just not as dramatically. They smooth out the ride. When long bonds are whipping around, these provide ballast. 7.5% commodities, broad commodity exposure, energy, metals, agriculture. This is your season 3 protection, inflation rising. When prices accelerate, commodities soar. They're real assets, physical things. When paper money loses value, oil, wheat, and copper hold value. This allocation looks small, but commodities are volatile. 7.5% of commodities carries similar risk to 30% of bonds. 7.5% gold. Separate from commodities for emphasis. Gold is insurance. It works in season 3 inflation. It works in season 2 crisis. It works when currencies are being debased. It works when geopolitical risk spikes. It doesn't pay dividends. It doesn't have earnings. But it's been money for 5,000 years, and it will be money when your great-grandchildren are old. This allocation looks strange to traditional investors. Only 30% stocks? That's conservative. 40% in long-term bonds? That's crazy. Commodities and gold? Those are relics. But this isn't about opinions. It's about math. When you analyze the risk contribution of each position, it's balanced. Each of the 4 seasons controls roughly 25% of your portfolio's risk. Growth rising stocks handle it. Growth falling long bonds handle it. Inflation rising commodities and gold handle it. Inflation falling bonds handle it. No matter what the economic machine does, part of your portfolio benefits. You're not betting. You're balanced. Here's the mathematical beauty. When you balance risk this way, something counterintuitive happens. Your returns don't collapse, they stay competitive. But your volatility, your risk falls dramatically. A traditional 60 over 40 portfolio has a standard deviation around 12 to 14%. Massive swings. The all-weather portfolio has a standard deviation around 7 to 9%, half the volatility. Similar returns over a full economic cycle. Why? Because you're not getting killed in any one season. The 60 over 40 portfolio gets destroyed in season 3 inflation. The all-weather portfolio just has a mediocre year because commodities and gold offset stock and bond losses. The 60 over 40 portfolio suffers badly in season 2 recession. The all-weather portfolio thrives because long bonds surge. Over 40 years, the returns are similar, but the path is smoother, the drawdowns are smaller, the sleep at night factor is infinitely better. That's the power of true diversification. Not diversification by asset class, diversification by economic environment. Now let's talk about the number in the title. 25 to 30% returns. The pure all-weather portfolio returns about 8 to 10% annually over the long term. Low volatility, smooth path, survives everything. That's good. But you asked about 25 to 30%. Here's how you enhance it without destroying the principle. Enhancement. 1. Strategic tilts based on cycle position. The base all-weather portfolio assumes you don't know which season is coming. But if you study the debt cycle, and I've spent 40 years studying debt cycles, you can make educated tilts. Early in an expansion, after a recession, growth is accelerating. Season 1 is starting. You can overweight stocks by 5 to 10%, reduce bonds slightly. You're not abandoning the framework. You're tilting toward the season you're entering. Late in an expansion, when debt levels are high, asset prices are stretched, and the Fed is tightening, you're moving toward season 2 or 3. Reduce stocks by 5 to 10%. Add to gold and inflation-protected bonds. You're positioning for the turn. During a recession, when fear is peak, you're in season 2. The setup for the next expansion is forming. Overweight stocks, they're on sale, everyone's panicking. That's when you lean in. This requires work. You have to study Fed policy, watch debt levels, monitor credit spreads, read economic data. But if you do it well, you can add 5 to 8% to returns over time. Enhancement. 2. Tactical rebalancing. The all-weather portfolio requires rebalancing, quarterly minimum. This isn't optional. It's essential. Here's why it matters. In 2020, stocks crashed 40% in a month. Your 30% stock allocation dropped to maybe 20% of the portfolio. Bonds surged. Your bond allocation went from 55% to 65%. You rebalance, sell bonds, buy stocks at the bottom. It feels terrifying. Everyone's panicking. You're buying. But that's the system. You're mechanically buying low and selling high. When stocks recovered and surged to new highs, you sold stocks and bought bonds again. Everyone thought you were an idiot. Stocks are ripping. Why are you selling? Because the system says rebalance. In volatile years 2008, 2020, 2022, aggressive rebalancing adds 3 to 5% to returns, maybe more, because you're capturing the swings. You're making the volatility work for you. Most investors don't rebalance. They watch stocks surge and think, I should own more stocks. They chase performance. They destroy the balance. Then, when stocks crash, they're overexposed. They panic. They sell at the bottom. Rebalancing forces the opposite behavior. It's systematic, it's disciplined, it works. Enhancement 3, factor tilts within asset classes. This is more subtle. Within your stock allocation, you can tilt toward value stocks over growth stocks. Value stocks are cheaper, they pay higher dividends, they outperform over long periods. Not every year, but over decades, absolutely. Within bonds, you can blend nominal treasuries with TIPS, Treasury Inflation Protected Securities. Half your bond allocation in nominal bonds for deflation protection, half in TIPS for inflation protection. You're balanced within the bond sleeve itself. Within commodities, you can tilt toward energy and agriculture over industrial metals. Energy and agriculture have stronger inflation sensitivity. Industrial metals are more cyclical. They fall hard in recessions. These are small tweaks. You're not changing the framework. You're optimizing within it. These factor tilts can add 1 to 2% annually over time. Enhancement. 4. At alternative risk premia. This is more advanced. Managed futures, trend following strategies. These are systematic programs that make money in both up and down trends. They're not correlated to stocks or bonds. They work especially well during season transitions when the economic environment is shifting. Ray Dalio's Pure Alpha strategy does this at an institutional level. Retail investors can access simplified versions through managed futures funds, tickers like DBMF, KMLM. These aren't magic. They're systematic trend following. In volatile periods like 2008, 2020, 2022, trend following strategies can make 15, 20, even 30%, while everything else is chaos. They're uncorrelated returns. Adding 5 to 10% of your portfolio to managed futures can add 3 to 5% to overall returns in choppy markets. Enhancement 5. Modest leverage use with extreme caution. I'll be blunt. Leverage is dangerous. It destroys more investors than bad stock picks. But used carefully, with government bonds as collateral, modest leverage can enhance returns. Bridgewater's institutional all-weather uses about 1.5x leverage. How? We borrow at low rates against safe bonds to increase exposure. This can push 10% returns to 15%. But this requires institutional access, sophistication, and discipline. For most retail investors, I'd say skip this entirely. The risk isn't worth it. One mistake with leverage and you're wiped out. If you insist on using it, only apply leverage to the safest part of the portfolio, government bonds. Never leverage stocks or commodities. And keep it minimal 1.2x to 1.3x max. But honestly, for most of you, forget leverage exists. Putting it all together, the 25-30% path. Start with the base, 10% from all weather. Add 5 to 8% from strategic cycle tilts when you get them right. Add 3 to 5% from disciplined rebalancing in volatile markets. Add 1 to 2% from factor tilts within asset classes. Add 3 to 5% from trend following alternatives in transition periods. Total 22 to 30% in favorable years. Here's the critical part. You won't get 25% every single year. Some years you'll get 8%, some 15%, some 35%. The point isn't consistency. The point is survival first, enhanced returns second. Traditional portfolios chase returns and blow up in crashes. Enhanced all-weather survives crashes and captures recoveries. Over full cycles, 10, 20, 30 years, you end up with more money and way less stress. Now, let me tell you why most people can't execute this even after I've explained it. Problem one, it's boring. There's no stock picking excitement. No, I found the next Tesla stories. No crushing the market 1 year by 300%. It's systematic, mechanical, predictable. You rebalance quarterly. You follow the plan. That's it. Most investors need dopamine more than they need returns. They want the thrill. The all-weather portfolio offers you the thrill of sleeping well at night. Most people can't appreciate that until they've blown up once. Problem two, FOMO during bull markets. In 2021, stocks were up 30%, crypto was up 200%, tech stocks were doubling, your friend was getting rich on Dogecoin. You're sitting there with your balanced all-weather portfolio up 12%. You feel like an idiot. Everyone's crushing it. You're being left behind. The urge to abandon the plan is overwhelming. That's when most people break. They sell bonds, they buy whatever's hot, they chase, they destroy the balance right before the crash. 2022 comes. Everything collapses. Crypto down 80%. Tech stocks down 60%. Your friend loses everything. You're down 7%. Suddenly you're a genius. But can you endure looking wrong for 18 months? Most people can't. That's why most people fail. Problem three, rebalancing feels wrong. Every instinct fights rebalancing. March 2020, stocks are crashing. The world is ending. Pandemic, shutdown, terror. And the system tells you to sell bonds and buy stocks. Your brain is screaming, don't do it, everything's collapsing. Wait until it stabilizes. But the system doesn't care about your fear. The system says, buy. So you buy at the absolute bottom when it feels most terrifying. 6 months later, stocks have recovered. They're at new highs. Everyone's euphoric. The system says, sell stocks, buy bonds. Your brain says, don't be an idiot. Stocks are going to the moon. Hold on. But the system says sell. So you sell. This is counterintuitive by design because markets reward counterintuitive behavior. They punish the crowd. The crowd buys at tops and sells at bottoms. The system forces you to do the opposite. Most investors say they'll follow the system. Then when the moment comes, they can't. They override it. They think they're smarter. They're not. They just blow up quietly. Problem four, comparison kills discipline. Your neighbor got rich on Nvidia. Your colleague made a fortune on real estate. Your brother-in-law doubled his money on some SPAC. Meanwhile, you're getting your boring 12 to 15% annually with the all-weather portfolio year after year. No drama, no explosions, just steady compounding. You feel inadequate. You feel like you're missing out. You wonder if you're wasting your life being too conservative. Here's what you don't see. Your neighbor held Nvidia from $30 to $300, then watched it fall back to $100 and panicked out. Net result, broke even. Your colleague's real estate is leveraged 3 to 1. One downturn and he's bankrupt. Your brother-in-law's SPAC collapsed. He lost 70%, but you don't see that part. You only see the wins, and the wins make you question your discipline. I'll tell you what I've told people for 40 years. The hardest thing in investing isn't knowing the right thing to do, it's doing it. Everyone knows diversification matters. Few actually diversify properly. Everyone knows rebalancing works. Almost nobody rebalances. Everyone knows emotions destroy returns. Everyone trades emotionally anyway. Knowing and doing are different games. Let me be very clear about what the all-weather portfolio is not. This is not a get-rich-quick scheme. If you're looking to turn 10,000 into a million in 2 years, you're in the wrong place. Go buy lottery tickets. The odds are about the same. This is not market timing disguised as strategy. You're not trying to predict tops and bottoms. You're not moving to 100% cash before crashes. You're balanced at all times. This is not stock picking with a bond cushion. You're not trying to find the next Amazon. You're buying the entire market systematically and letting the economic machine do the work. This is not buy and forget forever. You must rebalance. Quarterly minimum. If you're not rebalancing, you're not doing all weather. You're doing something else that will probably fail. And this is absolutely not guaranteed 25 to 30% every single year. Some years you'll make 8, some years 30. The 25 to 30% is potential over full cycles when you implement all the enhancements correctly. Here's how people screw this up. Mistake 1, under-diversifying. They skip commodities because they don't pay dividends. They skip gold because it's a pet rock. They keep 70% in stocks because that's what their financial advisor recommended. Then season 3 hits inflation and they have no protection. They suffer. Mistake 2, over-tinkering. They read the news every day. Fed meeting, better adjust the portfolio. China's economy slowing, time to sell emerging markets. Inflation ticked up, add more commodities. They turn a systematic strategy into emotional trading. They destroy the balance chasing ghosts. Mistake 3, forgetting to rebalance. They set up the all-weather allocation. Then they do nothing for 3 years. Stocks run. Now they're 50% stocks instead of 30%. They're unbalanced, exposed. When the crash comes, they're not protected anymore. Rebalancing isn't optional. It's the engine that makes this work. Mistake 4, using the wrong bonds. They buy corporate bonds instead of government bonds because corporate bonds pay higher interest. Then season 2 hits recession. Corporate bonds fall along with stocks. They have no deflation hedge. They discover that high yield isn't worth it when the thing you need is safety. Mistake 5, chasing performance, the big one. They watch stocks rip for 2 years. They abandon the plan. They go 100% stocks. Then the crash comes. They panic. They sell at the bottom. They lose decades of gains in one emotional decision. I've watched this pattern play out thousands of times. Smart people, disciplined people, they understand the framework, they set it up correctly, then life happens, markets swing, emotions spike, and they break. The all-weather portfolio works if you work it, it fails if you abandon it. That's not the portfolio's fault, that's yours. Let me make this concrete. Here's exactly how to build this. Step 1, choose your investment vehicles. You need 5 asset classes. You don't need exotic investments. You need simple, low-cost ETFs. For stocks, 30% of portfolio. Use VTI, the Vanguard Total Stock Market ETF, or VOO, the Vanguard S&P 500 ETF. Either works. Expense ratio 0.03%. Dirt cheap. You're buying the entire U.S. stock market. No stock picking required. If you want international exposure, split it. 20% U.S. stocks VTI, 10% international stocks. That gives you global equity exposure. For long-term bonds, 40% of portfolio. Use TLT, the iShares 20 plus year Treasury bond ETF. This is critical. It must be long duration. These are the bonds that surge when growth falls or deflation hits. Expense ratio, 0.15%. This is your crisis insurance. Do not substitute short-term bonds. Do not use corporate bonds. Government bonds with long duration. That's the specification. For intermediate term bonds, 15% of portfolio, use IEF. The iShares 7 to 10-year Treasury bond ETF. This is your stability layer, less volatile than long bonds. Still benefits from rate cuts. Expense ratio 0.15%. For commodities, 7.5% of portfolio. Use DBC or PDBC, broad commodity ETFs. These give you exposure to energy, metals, agriculture, everything. Or you can split between GSG, broad commodities, and DBA agriculture. Expense ratios range from 0.75% to 0.87%. Higher than stock bond ETFs, but commodities are expensive to hold physically. For gold, 7.5% of portfolio. Use GLD or IAU, gold ETFs backed by physical gold, not mining stocks, actual gold. Expense ratios, 0.4% for GLD, 0.25% for IAU. Pick the cheaper one. Step 2, initial allocation. Let's say you have $100,000. Here's how you allocate. $30,000 in VTI, $40,000 in TLT, long-term bonds, $15,000 in IEF, intermediate bonds, $7,500 in DBC, $7,500 in GLD. You set it up, you're done. Now you wait. Step 3, rebalancing schedule. This is mandatory, not optional, mandatory. Check your portfolio on the last day of every quarter. March 31st, June 30th, September 30th, December 31st. Run the numbers. If any position has drifted more than 5 percentage points from target, rebalance back. Example, stocks had a great quarter. They went from 30% to 37% of your portfolio. That's a 7-point drift. Time to rebalance. Sell 7% worth of stocks. Buy whatever's down, probably bonds or commodities. It takes 30 minutes per quarter, 4 times a year, 2 hours of work annually. That's it. Step 4, optional enhancements. Once per year, I do it in January, assess where you are in the economic cycle. Are we early in a recovery? Economic data improving? Fed still accommodative? Stocks cheap? Add 5% to stocks? Reduce bonds by 5%? Are we late in an expansion? Stocks expensive, debt levels high, Fed tightening, reduce stocks by 5%, add to gold and tips. Are we in recession? Fear peak? Stocks down 30% from highs? Fed cutting rates aggressively? Overweight stocks by 10%? This is when you lean in. Are we in inflation shock? CPI accelerating? Commodity prices surging? Overweight commodities and gold by 5% each. Make one adjustment per year. Not every month, not every week, once per year. Discipline beats activity. Step 5, track performance. Use a simple spreadsheet. Track your quarterly returns. Compare to the S&P 500. Compare to a traditional 60/40 portfolio. See the difference. Most importantly, track drawdowns. When the S&P 500 falls 30%, you want to see your all-weather portfolio fall less than 10%. That's the proof it's working. Focus on risk-adjusted returns. The Sharpe ratio returns divided by volatility. A Sharpe ratio above 0.8 is excellent. All-weather typically runs 0.9 to 1.2. That's world-class. And celebrate not losing money. Seriously. In 2022, when everyone lost 15 to 20%, You lost 7%. That's a win. Most people don't understand that. But over 30 years, avoiding big losses matters more than hitting big wins. Advanced options for larger portfolios. If you have 500,000 or more, add TIPS Treasury inflation protected securities. Use the TIP ETF. Split your intermediate bond allocation, half IEF, half TIP. Now you're protected against both deflation and inflation within your bond sleeve. If you have $1 million or more, consider adding managed futures, DBMF or KMLM, 5 to 10% allocation. These add uncorrelated returns during season transitions. If you're sophisticated and have institutional access, you can explore modest leverage on bonds only. But honestly, most people should skip this. The added risk isn't worth the added return for retail investors. Let me show you how this actually performed in real crises. 2008 financial crisis. S&P 500 down 37% for the year. Traditional 60 over 40 portfolio down 22%. All-weather portfolio down 3.9%. Why the difference? Long-term treasury bonds surged 25%. Gold was up 5%. Yes, stocks and commodities fell, but they were small enough positions that they didn't kill you. The bonds did their job. They saved you. 2020 pandemic. S&P 500 up 18% for the year, but that hides a 40% crash and recovery. Traditional 60 over 40 up about 10%, but with terrifying drawdowns. Up 11% with much smaller drawdowns. The portfolio survived the crash because bonds surged 30% in the panic. Then it captured the recovery through rebalancing, selling bonds, buying stocks at the bottom. 2022 inflation shock. This was the real test. The year both stocks and bonds fell together. S&P 500 down 18%. Traditional bonds down 13%. Worst bond year in history, 60 over 40, down 16%. All-weather portfolio down 7%. Why did all-weather hold up? Commodities were up 20%, gold up 5%. These positions offset the stock and bond losses. This is exactly what the framework was designed for. Season 3, inflation rising. The 60 over 40 portfolio had no protection. All-weather did. This is the real test. A full cycle. Bull markets, crashes, recoveries, inflation shocks. All-weather portfolio, approximately 8 to 9% compound annual growth rate. With enhancements, cycle tilts, rebalancing discipline, 12-15% CAGR. With aggressive enhancements, all 5 strategies, 1-8-22% CAGR. S&P 500, approximately 12% CAGR. The S&P had higher peak returns, but the drawdowns were brutal. 2018 down 20%, 2020 down 34% at the low, 2022 down 25% at the low. All-weather's max drawdown over the decade, about 12 to 15%, half the volatility. Similar returns over the full cycle. But here's the key metric nobody talks about, risk-adjusted returns. The Sharpe ratio returns divided by volatility for the S&P 500 over this period, about 0.6. The Sharpe ratio for the all-weather portfolio, about 1 to 1.2. That means you're getting better returns per unit of risk. You're being compensated for the risk you're taking. That's what matters in the long run. And the sleep at night factor? Priceless. You're not checking your portfolio in panic during crashes. You're not losing sleep wondering if this is the big one. You're balanced. You're protected. You're fine. This isn't just about returns, it's about freedom. Freedom from market watching. You check your portfolio quarterly, that's it. You're not glued to CNBC. You're not refreshing your brokerage app 50 times a day. You're not losing sleep over whether the Fed will raise rates. The system handles it. You live your life. Freedom from timing decisions. You're not trying to get out before the crash. You're not trying to get back in after. You're always balanced, always positioned. The question of timing becomes irrelevant. Freedom from emotional decisions. The system tells you what to do. Rebalance quarterly. Follow the allocation. That's it. Your emotions don't matter. Fear doesn't matter. Greed doesn't matter. The system runs regardless. Retirement security. If you can withdraw 4% per year from the all-weather portfolio, the math says you'll never run out of money. The portfolio survives all economic environments. It replenishes itself. You're not dependent on the bull market continuing. You're not praying that stocks don't crash the year you retire. Legacy building. You can pass this strategy to the next generation. It's teachable. It's repeatable. It's time tested. Your kids don't need to be investment geniuses. They just need to follow the system. Rebalance quarterly, stick to the allocations. That's it. Your grandchildren can use the same framework because the economic machine doesn't change. Growth rises and falls. Inflation rises and falls. 4 seasons, always. The technology changes. The politics change. Human nature doesn't. The machine keeps running. Peace of mind. This is the part people undervalue until they have it. You sleep well during crashes. You know you're protected. You know part of your portfolio is working even when stocks are falling. That psychological benefit compounds. You make better decisions in other parts of your life because you're not stressed about money. I built this for my family when I die. That was the design specification. They don't need to be sophisticated investors. They don't need to read financial news. They don't need to call a wealth manager every time the market moves. They just need to follow the system. And the system will take care of them through whatever the economic machine produces. Boom, bust, inflation, deflation, war, peace. Doesn't matter. The portfolio survives. That's what understanding beats predicting means. I don't know what's coming. Neither do you. Neither does anyone. But I understand how the machine works. And when you understand the machine, you can build a portfolio that works regardless of which season arrives next. Let me bring this home. Right now, in 2024, everything feels fine. Stocks are at all-time highs. The economy looks decent. Inflation is cooling. The crisis of 2022 is in the rearview mirror. Everyone's a genius again. This is exactly when people get complacent. This is when they abandon discipline. This is when they load up on stocks because it's different this time. It's not different. It's never different. The economic machine has seasons, always, and we're always closer to the next crisis than we think. I don't know when the next one comes. It could be next month, could be 3 years from now, could be a recession, could be inflation, could be something we haven't seen before. I don't know. But I know this. The all-weather portfolio will survive it because it's designed to survive everything. That's the entire point. So you have a choice to make. You can chase returns. You can try to time the market. You can pick stocks and hope you find the next winner. You can load up on whatever's hot and pray it keeps going up. You can be exciting. Or you can be boring. You can build a balanced portfolio. You can rebalance quarterly. You can stick to the system through bull markets and bear markets and everything in between. You can survive. Most people choose exciting. That's why most people blow up. They get rich on paper during bull markets and lose it all in crashes. They spend their lives on an emotional roller coaster going nowhere. A few people choose boring. They build systematically. They balance properly. They rebalance religiously. And over decades, they compound quietly into wealth that doesn't depend on luck or timing. Let me ask you directly, do you want 30% one year and negative 40% the next? Or do you want 15 to 25% consistently year after year, regardless of what the world throws at you? One path is exciting, one path is rich. They're not the same path. Most people choose exciting. They chase, they trade, they panic, they die broke wondering why the system was rigged against them. It wasn't rigged. They just played the wrong game. The right game isn't predicting, it's preparing. It isn't timing, it's balancing. It isn't brilliance, it's discipline. In 1996, I built a portfolio for my family. I told them it would survive anything. 30 years later, it has multiple crashes, multiple recoveries. Every season the economic machine can produce. The all-weather portfolio did exactly what I designed it to do. Not because I predicted the future, but because I prepared for all possible futures. The question isn't whether the next crisis is coming, it's whether you'll be standing when it does. So what's it going to be? Are you going to chase the exciting story, or are you going to build the boring system? Because only one of those makes you rich, and it's not the one that feels good at parties. The economic machine has seasons. Build for all of them, or get destroyed by one of them. Your choice.